Good morning, everybody. Welcome to another brought to you by Mike Bjork. Today is Tuesday, March 17th. Happy St. Patrick's Day to you all. Hope you guys have a good, safe day today. Have fun out there, but be safe. Hey, stay tuned to the end of here. There's a little tip I want to give to you guys regarding to pre-approvals. Something that the CFPB new regulations kicking in. I want to share with you guys and thoughts on it. So stay tuned. But today we'll start off with the economic calendar first. We'll have the housing starts for the month of February. So back in January, it was actually revised upwards. So it was like 1.7 and 07, and it jumped up to 1.08 revision. The forecast is at basically 1.03, and it actually was even lower than the forecast due to the weather in the East Coast and Midwest during the month of February. So it dropped out down to 897,000. But on the other hand, when you look at the building permits, it actually jumped upwards. So that was a nice sign there. So as you can see, back in January, we had just over 1 million, 1.06 million. And it jumped up to 1.09, so that kind of shows you the future of where housing starts will go later on. Stock market's down. It's kind of in anticipation for the FOMC meeting that began today, and we'll have their announcement tomorrow. There's a lot of anytime you have these transitory areas, there's always a little nervousness, especially with investors, because basically the rest of the world is trying to create stimulus packages. We've already stopped the stimulus package, and now we're actually looking ahead and possibly raising rates. So the concern is that they'll probably take out the patience word, the wording of the FOMC, which Janet Yellen kind of, from a previous speech, kind of forewarned everybody about that, and it doesn't mean necessarily that they're going to raise rates. It just means that they're going to be taking that wording out because they're kind of going into a transitory period. There's concerns by investors that maybe they'll start raising rates between June and September timeframes, but again, some of the things that I think a lot of people forget about is that the Fed, even when they started quantitative easing, they wanted unemployment get down to about 5% and 2% for inflation. We're still a ways away from that. Unemployment's still about 5.5% last reporting, and inflation's still very low right now. And I think so what they're going to be looking for is wage. Obviously we want to see wages going upwards, a little bit of inflation, seeing the inflationary go up a little bit on an organic level here. So seeing people make a little bit more money, spending a little bit more money before they start raising any interest rates. So I don't think we'll see that real soon, personally. But they're kind of spooking a little bit with the thought of it possibly going out. So anytime there's a transitory, they will spook and probably go the opposite direction. So that could help bode well for us bond people who want interest rates good, low rates. So what happens, they'll take out the equity markets because they'll get spooked, and they'll park that into a safe haven such as bonds, and that will help out interest rates for the short term here. All right, so let's go ahead and take a look at the bond market as we're speaking. And it's up a little bit for today. We got a little bit of improvement in the interest rates today, so that's a good sign for us, obviously. Now, to get back to regards to new regulations kicking in for the pre-approvals. This is something you probably want to really be cautious on if you're a realtor, or even a person who wants to go buy a home, is that typically on a pre-approval, a loan officer will ask for all the documentation, verify the information before they give an approval. Going forward, the CFPB is going to relax on that, and so my opinion, lazy loan officer is going to take advantage of that and not ask for that. They're just going to write a blanket pre-approval, which will mean nothing, and the paper won't mean nothing. So going forward, I'd be a lot more cautious. As it is, there's sometimes issues that pop up on there because the loan officer may not have done all the work, or perhaps for miscellaneous things that could have popped up during that transaction. But this could even worsen things and make it a lot more dangerous going forward for a seller to accept an offer without a credit approval. So my recommendation going forward is make sure that you have a full credit approval for your client. All they have to do is find that property. So I would strongly caution that make sure your loan officer does a full credit approval. Make sure that they review everything to make sure they are fully qualified to buy that property that they're making an offer on. All right, so I just want to give you a heads up. If you haven't seen the news, check out Frank and Brian's the National Real Estate Post view yesterday. I'll go ahead and I'll post a link below, so go ahead and click on it, take a look at it, and you'll see for yourself. Have a wonderful day and take care. And again, have a happy St. Patrick's Day. Bye bye.